Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is Espire Hospitality. So let's see the business. So Espire Hospitality is a distinguished name in the hospitality sector, managing a diverse portfolio of hotels and resorts. The company operates a multi-brand strategy catering to different market segments. They have three key brands. At the pinnacle of the luxury segment stands Six Senses, Six Senses brand, setting new standards in ultra luxury hospitality. Then Zana Luxury Resorts caters to affluent and upscale guests seeking immersive high-end experiences, while Country Inn Hotels and Resorts continues to be the trusted choice for mid-scale travelers, offering comfort, consistency, and value. Now, to address the company's past, it's important to be aware of its history. Aspire Hospitality was formerly known as Wesley Corporation Ltd and was originally promoted by the Usha Group, whose core promoters Vinay Rai and Anil Rai had a history of serious financial fraud and regulatory violations. These issues, including CBI cases and SBI penalties for market manipulation, were tied to the past. However, the company has since been completely transformed. The Rai brothers have no current involvement, no shareholding, and no position on the board. The company is now professionally managed with a new team with strong industry credentials, and the business itself was built under the vision of late Mrs. Sadhana Rai. This marks a complete strategic pivot, mainly after March 2022, to a new professionally run hospitality business. Now let's see the industry overview. So the Indian hotel sector is poised for significant growth driven by strong macroeconomic trends and changing consumer behavior. The travel market in India is projected to reach 125 billion by FY27, up from 75 billion in FY20. According to the World Travel and Tourism Council, India's travel and tourism GDP is expected to grow at an average of 7 to 8% annually. Key performance metrics are also on an upward trajectory. Occupancy is expected to improve by 500 basis points. Average room rate ARR is also projected to grow at a 7 to 8% CAGR. Now, the growth drivers for the Indian hotel sector is driven by three key factors: domestic travelers, foreign tourist arrivals, and MICE segments. So, domestic air traffic has seen a remarkable 15% increase over 2019 levels, with total air traffic reaching 408 million. Domestic travelers are expected to contribute 50% of the incremental growth in this sector. Although FTS, which is foreign travel arrivals, saw a 12% drop compared to 2019, they are anticipated to account for 30% of the total growth in coming years. International air traffic is up 8% over 2019, indicating strong potential for this segment to rebound and drive growth. MICE, which is meetings, incentives, conferences, and exhibition. The Indian MICE market is valued at $3.3 billion. This segment, which includes both domestic and international events, is likely to contribute the remaining 20% of the growth. Now, the management overview. So, the management team at Aspire Hospitality brings a wealth of experience and expertise to the company. They have a strong foundation in hospitality sectors and are well equipped to drive the company's growth. A key figure, Mr. Akhil Arora, who was recently appointed. He is the CEO and MD. He is an industry veteran with over 20 years of experience in hospitality. Before joining Aspire, he held key positions at prestigious brands like Oberoi, Leela, and Imperial. He was also instrumental in setting up and running the asset management division at Hotel Niviad. His diverse knowledge covers hotel operation, business strategy, and revenue management. Under his leadership, the group has successfully expanded its portfolio from 2 to 10 operating hotels, and now they are going beyond that also. This is their current portfolio. These are the current hotels and resorts that they currently have. And apart from this, I think here 10 are mentioned. Apart from that, they have also acquired more and more hotels. They are currently in talks with 20 other hotels and has a target of reaching 30 hotels in FY26. So that is a very good target. I think they are targeting for more than 1,000 keys, basically 1,000 rooms for this year in FY26. As you can see, these are their goals. They are trying to get more than 1,000 keys and rapidly expand their portfolio. Now, let's see the key takeaways. So, the company has reported its highest ever quarterly and annual performance in revenue, EBITDA, and PAT. This is supported by a very good ADR and RevPAR in Q3 and Q4, both significantly outperforming industry averages. Then the company also has an aggressive plan to double its current inventory by adding another 600 or so rooms by the end of FY26. It has already signed 5 new properties and as in advanced negotiation for over 20 more, aiming to add over 1,000 keys in the coming year. A strategic market penetration, the expansion is strategically focused on high growth leisure and spiritual destination like Rishikesh, Udaipur, Goa, and Vrindavan, which are benefiting from the boom in domestic tourism. Then Aspire operates a well differentiated portfolio of brands, including the ultra luxury Six Senses, the boutique luxury Zana Resorts, and mid market country in hotels, catering to a wide range of travelers. And lastly, the company is now led by a very professional management team with very extensive experience in the hospitality industry. Particularly, our CEO, Mr. Akhil Arora, has a very proven track record of expanding hotel portfolios. So that is a very good thing. Now, the bull case, a successful execution of expansion. If the company successfully executes its aggressive plan to double its hotel inventory by FY26, it can lead to a significant increase in market share and revenues. Next, sustained premium pricing. If Aspire is able to maintain its high ADR and RevPAR, demonstrating continued brand strength and pricing power, which in turn drives robust profitability as new properties become operational. Third is if the company effectively capitalizes on the strong macroeconomic drivers such as growing middle class and a booming domestic travel market, which are expected to fuel the Indian hotel sector's growth. Lastly, the planned 300 crore upper luxury resort near Vrindavan and other uber luxury projects in Mussoorie and Mumbai are, if they are successfully developed, they can establish the company as a leader in the high-end segment, leading to premium valuations. Now, the bear case. So, the aggressive expansion plans, particularly the large-scale projects like Vrindavan Resorts, if they face delays or cost overruns, it could strain the company's finances and impact profitability. Next, if there is increasing competition from larger, well-capitalized domestic and international hotel chains, it could put pressure on Aspire's ability to maintain its premium ADR and RevPAR. Then, and if there is an unexpected downturn in the economy or other external shocks, that could negatively impact travel and tourism, which can lead to lower occupancy rate and a decline in overall performance. Although chances of this happening is, I think, less because the hospitality industry just came out from the negative economic downturns after COVID and all. So the chances of it happening again is a bit low, but still. Lastly, rapidly adding new properties can lead to challenges in maintaining a consistent quality of service and brand experience across the portfolio, which could damage the company's reputation. Now let's see the company through our framework. So section 1, governance and promoter behavior. So let's see the fundraise. So as I mentioned, the company has been listed quite a while back, but then were other companies. Our company basically was a dormant company, dormant shell company, which actually became active and all this hospitality business in their segment after basically 2022. After that, they have recently raised a preferential issue of around 32 crores in March 2025. I did not find the use of particular mention of where they are going to use these funds, but I think it is mostly for capex only because they are trying to use these funds to the mix of equity and debt. They are trying to fund the 300 crores hotel which they are doing in Vrindavan. So that is why I gave a 5 score. Direct and promoter track record. So direct and promoter track record as per the current board and current promoters which we have, it is very clean. The old promoters which had all the issues and the holding company Usha Limited, everything has gone away. This is the new management and new board. They don't have any legal issues or any bad track records about them. So that is why I give a 5 score. Mr. Amit Rai has shareholdings around 2.2, around 3% something, 2.5 or percent something. And he is also the son-in-law of Mrs. Leela Vish. She doesn't have any shareholding, only Amit Rai has. So that is why I give a 5 score. Now, related party transaction, as you can see, there has been a lot of related party transaction. Mostly loans and everything is there. They had also issued a 10 crores debenture to another related party transaction. And if I tell you the total, so related party loans of around 16.85 crores at 8% interest for almost 7 years we have. So it is all related party transactions. So because the amount was too big, 41 crores, 18 crores and all. So that is why I gave a 0 on 5 score. Now, board composition, if you say it is a very, as I said, it is a professionally managed board and only two people are family on board right now. So that is why I gave a 5 score. Remuneration also, if you say it is good, also I gave a 5 score. Now, key person resignation also, if you see, there has been a lot of resignations. Mostly it was mentioned as personal reasons only. So that is why I gave a 0 on 5 score. Lot of directors had resigned. MD has resigned 2 times. So that is why I gave a 0 on 5 score. Auditor resignation also, if you see, 3 auditor resignation has happened. Statutory auditors, internal and secretarial auditors. So that is why I gave a 0 on 5 score. Auditor opinion has been unmodified and credit opinion is not there. So I gave a 5 score. There, I did not find any regulatory or legal issue as of now. After with this company, there was never an issue. The only promoter company had issues. So it is has a clear track record. So I gave a 5 score. PPT is there, but only two in December and March they have uploaded, and that is also not very detailed. The main key metrics, the average, say average and revenue per occupancy rate. These two, three things they have mentioned in 5 slides. They have repeated again and again. So it was also not very informative. And of course, they are not doing con calls and annual report is also not yet out. So that is why I gave a 0 on 5 score. Now, section 2, financial health, business concentration risk is not there. So I gave a 5 score. Cash flow by EBITDA, if you say it is very fluctuating in nature and in FY25, it has gone negative. I think mostly it is because they are rapidly expanding. They are aggressively opening new and new hotels and acquiring new hotels. But still, because it is in negative, I give a 0 on 5 score. Revenue growth, if you say receivables by revenue as a percentage of revenue, it is very low. So it's fine. So I give a 0.5 score. DSO is also fine right now. So I gave a 0.5 score. Cash conversion cycle is also been negative. So that is very good. It is so I gave a 0.5 score then also. Capex by revenue, whereas it is a bit high on a higher side. So that is why I gave a 3 on 5 score. Debt to equity ratio, as you can see, it is very high, although it has come down, but still it is very high. So I gave a 0 on 5 score. Liquidity position also, if you say it is not, it is very bad actually. So I gave a 0 on 5 score there also. ROE and ROC has been consistent for the last 3 years, but ROC has been a bit lower. So that is why I gave a 315 score here. Growth consistency, if we see revenue growth has been good, but EBITDA margins has dropped. EBITDA and EBIT margin has dropped. So that and gross margins has also dropped. So that is why I give a 315 score here. And overall, the score comes out to be 59. And for the valuation and final takes, I'll hand it over.
So basically, it becomes really difficult to judge because a lot of restructuring is happening, but they are very aggressive. One metrics I was looking as market cap to sales compared to many listed players, they are still at a discount, I would say. Leverage is something I would be very mindful of. As pointed out, debt to equity is high. It could work in your favor if the economy is doing good, but it could backfire if the economy slows down. So basically, they are into extra ultra premium luxury hotels and stays. So the two approaches they are doing is one is owning the property and second one is managing the property, which is asset light. So they are doing a mix of both. And they are signing a lot of property in terms of when it comes to managing it. For example, on August 6th, they have added 5 new hotels into your kitty and they target 30 hotels by FY26. So they are following a mix of asset light and also owning the property. So let's see how it plays. Like asset light would give you kicker in terms of revenue. When it comes to margin, yes, like that it looks like a slowdown, but again, because of the aggressive expansion, there are going to be cost pressures. If you're taking a 1 year forward target, it becomes extremely difficult to predict. This number is, I would say, extremely optimistic. So I'm not sure whether to even work with it. So let me just bring the margins down to 10 and PE to a more believable 25. The price target comes to 416 or something. Here, the price target is around 600. So I think it's because the revenue target I feel is extremely on the higher end. Maybe I think next year they can do around 200 to 250, but 470 is extremely high. If the PE, it's all again a PE game. If the PE is 50, then the target becomes 832. The reason I say PE 50 because many of the hotel stocks are trading at a bit of elevated PE. There is a lot of supply demand mismatches as well. Finally, coming, if you have a longer term view, let's see how it pans out. One good thing is the hotel industry, your debtor days are nil, you don't have much inventory, and your payable days are 300 days. So your cash conversion working capital cycles are really good. All you have to do is promote your hotel and do make sure you increase your occupancy. The negative 23 crores is because of the other working capital items. So basically all the new properties and everything that they're doing. So if you remove that, I remove 48 crores, you basically get 21 crores. So that looks fine. So the net profit is 10 and profit before tax is 13. So let's just take 10 to be conservative. And let's see what figure we are getting. And your required rate of return is 25. Terminal growth rate is 3. I'm actually being extremely conservative here. Number, if your holding period is 5 and the 5-year terminal multiple is 25. So from this point in time, the company has to grow at 56%. Again, 10 is extremely conservative, but the management is based on what they are doing, like basically from 30 or from 5 to 30, that is 3x jump. Sorry, that is 6x jump in the number of hotels that they are onboarding. This 56% growth or at least 50% growth year on year looks more achievable to me. Let's see, because the CEO is extremely has been in an industry and has a good track record in the past. So let's see how he executes. Only risk is the risk of dilution. That is again something that has to be borne in mind. But the properties are all really good, especially the Six Sense, the property. It's a ultra premium in Rajasthan. So, which is the one. So yeah, this is the property, right?
Yes, Sam.
So these are the different properties. So extremely high-end properties they are. So that's why the average room rent is also around 10,000 range. Let's see how that pans out and how they increase the occupancy here going forward.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.